All right. I think, can everybody hear me again? I had to move. Can everybody hear me?
Yes.
Oh, hi, Jeff.
I can hear you.
All right. Sorry about that. I lost my recording, so I had to quick get up and go find a stronger recording. So we're all here. So Ross, I'll just introduce myself and hand it over to you. Okay.
Yep.
It's like Law is on. And if Tracy comes on, she can do an introduction of her staff as well.
Yep. That sounds good.
All right. So this is just going to cook in here. So Ross, I sent out that spreadsheet to everybody this morning. I'm sure you saw that.
Yep. Yeah, that's good.
Okay.
I'll probably have a whole packet of stuff I'll send you after this. I got a worksheet of basic accounting terms that I threw together, and then I do have a little Excel example just to give people a super quick primer on things that Excel can do.
Okay, that's great. Actually, we're not going to send that out until the end, or until after people give me their evaluations, because I'm like dangling a carrot now to get evals back. So
yeah. Yep, that works.
Okay. Jeff, Jim Grothaus is here, so that's fun.
Oh, cool.
Yeah,
Say hello for me.
I will. Well, it's almost 11:30. We have been having trouble getting people here on time, frankly. Zoom user, hello, good morning. Who are you? And just let us know who you are so I know who's on the call. Well, I don't think.
Hi. Oh, hi. I'm sorry. It was taking me a little while to get off of mute. My name is Talea Jones. I'm with a company called Get Right in the Now Development. We're a new company and we're just trying to learn some financial management today.
Okay, excellent. Well, Talea, be prepared. I'm going to ask, or actually maybe Jeff or Ross, depending on the timing, will ask you to reintroduce yourself, but it's nice to have you, Talea. Do you know how to change your name? You go up to the upper right. Here, I'll rename you. How do you spell your name?
It's T as in Tom, A-L-A-I-A.
And what's your last name?
Jones.
That one I can get.
Exactly.
All right, so Talea, I changed your name for you.
Perfect. Thank you.
Of course, no problem. All right, so Ross, you should be able to share your screen and put the presentation up if you have one.
Yep. The screen's organized here.
Those pictures on your office look like little floating windows on your PowerPoint.
Oh, funny.
I have not figured out how to make somebody else the host. Oh, you are. Okay, so Ross, you are the host, okay?
Okay.
So I am still, so you should have free access. I'm still recording here on my computer.
Yep, that sounds good. Apparently, it looks like it wants me to share the other screen. Share screen too. That's better.
All right, good morning, everybody. It's 11:30 and we'll get started here shortly. We're still waiting for several participants. Tracy's here. Oh, okay. Well, I was just mainly waiting for Tracy so that we could introduce everybody. My name is Ann Johnson. I'm actually not part of the instructional team today, just part of the hosting team. I will be recording this video and this workshop for the next hour and a half. So be ready for that. Of course, we're recording them so that people can access them later. and download the closed captioned recorded video at a later time. So Ross Gentink is our instructor today. He'll be assisted by Jeff Stewart. So both of those guys are colleagues of mine, and they're the ones that really run the show at PE Services. I'm actually presenting at a conference, so when you see my camera go black, it's because I have to be in two places at one time. But we're going to have people introduce themselves. Tracy, I know you're here. Are you ready to say good morning?
I am ready. Good morning, everyone. I'm Tracy Jackson. I work in the MnDOT's Office of Civil Rights as the outreach coordinator and here to support small businesses. I've been working with small businesses for over 17 years in regards to certification, connecting you to contracting opportunities and trainings such as today. So we have trainings such as today. In addition, we have a full class schedule just the rest of this week and all month of May. So several opportunities. I'm going to put a link in the chat so you can sign up for more training. In addition to some of the training, we have networking events happening. I'm working with Ann here to get networking in Greater Minnesota. We do have an event in St. Cloud. And then we also have special events at PE Services offices May 17 and 18. So another opportunity to network with your businesses. The one on the 18th is more construction focused, but yeah, we'd love to have you sign up for those. So I will enter those into the chat so you can sign up. With that being said, enjoy the class. Ross, nice to meet you. Jeff, good to see you again. I'm looking forward to hearing about financial management. So I'll pass it back over to PE Services.
Thanks,
Thanks,
Tracy.
Tracy.
All right, so Ross, I think I'll hand it off to you. So if you just would have everybody just introduce themselves and briefly say what their company does, that would be great. Jeff, if you could just take notes about that, and I know Tracy is too. And then I'll check back in at a little bit before 1 o'clock and we'll wrap it up. So thanks a lot, you guys, for taking us on today.
There we are. Looks like I was muted. Thanks, Ann. Yeah, we'll get going here on the class after we do it. Finish introductions. I'm Ross Gentink. I'm the CFO of PE Services. I work with Jeff Stewart and Ann Johnson and the PE Services team here. Also do project controls for engineering, mostly construction, but contract changes, scheduling, things of that nature. So spend a lot of my time staring at numbers and figuring out how to budget and plan and look back and analyze things and really try to improve as we move forward on processes. But Jeff, you want to introduce yourself?
Sure. So I'm Jeff Stewart, and as Ross said, I work with him and Ann, and I'm actually the retired CFO of PE Services, and I pass the baton on to Ross. Ross is capable hands, and he's going to take the company and make it bigger and better. And so I'm just assisting with this class, but I have over 40 years of experience in consulting. And I was the CFO of PE Services here for the last 12 years.
Sounds good. Thanks, Jeff. Law, do you want to introduce yourself?
I'm Law, and I do lawn service mowing and snow removal. So I'm wanna get more information out of this class to benefit my business and for future needs. So yeah, it's nice to meet everyone.
All right, thanks, Laya. Let's hope we can maybe take a few pointers into what you're already doing and see if you can add more visibility to how your company operates and the financial piece of it. How about Talia? Or was it Talia? You want to reintroduce yourself? I know we talked a little earlier. All right, she might not be there yet. Rose, you want to go ahead and introduce yourself?
Hi there, yeah, my name is Rose Stensrud. I am the office manager at Shepherd Data Services. We're a legal services company offering e-discovery and digital forensic services.
All right, thanks, Rose. Let's see, next one there.
Hi, this
Michelle?
is Talea.
Oh, there you are, Talea. All right.
Hey,
Go
hey,
ahead.
I'm so sorry. I was trying to get myself off of mute again. That's that multitasking. I'm Talea Jones with Get Right in the Now Development. We are a multi-faceted company that does a lot of consulting and management work. So we're looking forward to just hearing more of this training.
Sounds good. And then it looks like, is it Michelle?
Yes, I am Michelle Call. I own Kismet Consulting. It's a transportation design company that I just started last August.
Sounds good, Michelle. Hopefully we can give you some good tidbits to help you advance your financial management as well. Then I noticed Jennifer Hildebrand is on it. Jennifer, if you want to introduce yourself.
Yes, hello, everybody. I'm Jennifer Hildebrand, and I work with Ann and Ross and Jeff here at PE Services. So nice to meet all of you.
Hey, this
All
is
right,
Tracy again. I'm just looking at attendance here. Talea, what's the name of your business? I don't have you on my registration list, but I want to make sure you're accounted for.
Yeah, it's called Get Right in the Now.
I was just taking myself off of mute. It's Get Right in the Now Development. Thank you.
Okay. All right. I'm adding you now. I'm glad you joined.
Appreciate it. Thank you.
All right, a few more have joined. Sarah, you want to give yourself an introduction?
Sure. My name is Sarah Hordick Portner. I'm the controller for Ironmark. We are a general contractor, primarily multifamily housing. Our core markets are Minneapolis, St. Paul, but we've recently expanded into Denver and Phoenix as well.
All right, sounds good. And then Matt, MnDOT, you want to give a quick introduction?
Yeah, sorry I'm late. I've been running in and out of meetings, but I work with Tracy in the Office of Civil Rights, the Business and Program Development. So I'm just seeing what's going on. So excited to be here.
Good. Thanks, Matt. Looks like everybody that we have on the call today. This is intended to be highly interactive. Now, my presentations are usually on boring subjects, so it's not always easy to make them highly interactive. But as we're going through things, hopefully everybody's comfortable asking questions. You can interrupt me. Jeff has a lot of experience in running a company, starting from a smaller company, growing it up to the size we are today. And so has a lot of great experience on things you guys might have questions. I currently am running all the financial management here. And so I can answer a lot of the more technical pieces as we're continuing to grow and show kind of what's going on. But Jeff, jump in anytime you want to. Like I said, stories are always good, or experience is definitely.
I will.
Yeah, everybody can learn from each other here. So, yeah, it's our financial management course. So big concept. What is financial management? Well, I mean, financial management is the looking at your company and understanding where your company's at, and from a financial standpoint, understanding all of the ways that your money is going in and out, understanding how to finance that money, and then forecasting what is going to happen in the future, or what you hope to happen in the future, and then constantly monitoring that and readjusting to basically pull the right levers at the right time to continue your company to be successful. Sometimes large expenses can goof a company up, or a project not coming in you thought was going to come in, and having a good vision of what that does to your financial picture going forward allows you to be adaptive in how you attack problems when they don't go well. If everything goes well in your company, you probably you should have a good financial system anyway, but it can run on autopilot just fine when everything's going well. But if you don't have it planned well when things start going poorly, it's a lot harder to get visibility to what's going on. So that's really a key to the financial management is it's a lot more than accounting and looking backward and just compiling. That's a piece of it. We have to do taxes. We have to have good financial practices. But it goes a step beyond that. And the financial management is really looking forward and understanding how your company is going to is intended to function going forward, and then being adaptive to things that don't quite go right. So, you know, a lot of us, or a lot of the companies, a lot of the DBEs, small businesses, we might be great at what we do, and you're great at whether it's the landscaping, lawn care systems, or building houses, or some of the other things that you guys are doing out there. But we're not always great at the accounting piece, and one of the key starting points is to hire a good accountant. You know, I look at what we've done this year with our accountant, and you know, we call and ask questions about, you know, we added a line of credit to our business, which we'll talk about a little bit, or I'll talk about how we forecast that and how we understand how to use that. Depreciation on vehicles, office expansion, things like that an accountant can help out with. You know, as our company is growing, we need more, or we're choosing to manage things more detailed, and so we break out accounts, and our accountant can help us. We're not experts at QuickBooks. We know how to reconcile accounts and set up things here and there, but our accountant can do mass changes in QuickBooks and really
That's your message. But
help
I'm
clean
also
our
seeing
data
that
up.
you signed up for this financial management class. Are you going to be joining? It's happening right now.
Hey, Tracy, you're
But yeah,
unmuted.
so there's a fair amount of things there that financial management, a good accountant is more than a person that's just doing your taxes. We call them, you know, maybe once a month, we have questions that we need help with. We go, I don't know how to make the system do what I want, or what is industry standard, or what are general accounting practices to make sure we're in compliance with the requirements that are necessary for our taxes. And the more we talk to our accountant, the quicker it is for them to do our taxes at the end of the year, because they're on board with everything we're doing. So, and they help set it up in the correct way. So there's not a lot of going back and fixing a lot of information. If we're reconciling our bank accounts against our invoices, and we're doing that every month in QuickBooks is what we use as our accounting system. We're doing that every month, and then it's pretty fast for our accountants to pull our taxes together. So what we're going to cover today, we'll go over some general financial terms. These, you know, they're pretty industry standard. You guys will know most of them. Some of them get a little more in the weeds. I'll send out, it sounds like after we get the reviews of, or you guys respond, rating the class and kind of giving your feedback on the class, then we'll send out a packet with it'll have all the general financial terms. It'll have the examples that I use, a couple of spreadsheets that I'm picking away at there that I'll show you guys that we use to manage our stuff. So you'll get a packet of information after that review comes in. Oop. Mouse wheel's a little too quick. I'm going to run through just a quick Excel tip. I think for the most part, I think most people are aware of how to use Excel. I'll just show a few things that are they're fairly high level in Excel, but I'll show you pretty much everything that I use to develop the spreadsheet that I'll show you guys. And so, you know, you won't be an expert at it, but you'll at least understand that it exists and how to use it. So then we'll go through and we'll develop an income statement, talk about being organized for record keeping, develop revenue forecasts, and develop expense forecasts, and then talk a little bit about monitoring that and look at a cash flow model so we understand how much money is planned to come in and out every month, and to try to understand that we have that money. And so we obviously makes life a lot more comfortable if we understand when we're not going to have money and maybe need to go get a line of credit or need to tap into some savings or something like that. Just be proactively managing that business model. So
Ross, real quick,
sure.
Ross had mentioned something that the accounting system we use is QuickBooks Online. And what's really nice about that particular program is our accountant then can log in to our account and actually see our financials real time. And that's really beneficial, as he said, when it gets close to the end of the year where you're getting prepared for doing the tax return. As most people know, or maybe they don't, that the business taxes are actually due a month earlier than our personal income taxes. They're due on the 15th of March. So getting your things in order to facilitate that later is really beneficial. And by having a program that you can actually share with your accountant, it really helps streamline that process. Okay, sorry for the interruption.
No, I appreciate that, Jeff. Great. Another thing we did this year was we took that QuickBooks Online and we added the ability to, we added classifications, which I won't get into a whole lot, but we were able to classify like allowable and non-allowable expenses based on FAR. And that helped us immensely in doing or submitting our overhead right now. So instead of going through after the fact and going, okay, is this allowable? Is it not? And kind of trying to figure out what those buckets are. Now we classify those through the year. And that was a mass change that we made that the accountant was able to do in minutes in front of us that would have taken us hours and hours to do on our own. So it's another good example of she was great at helping us figure out which buckets should be divided and how, and then we kind of set up guidelines. So as we reconcile our accounts, we do that typically weekly, but a lot of companies do it monthly. We reconcile our accounts and we make sure to get that classification, whether it's an allowable expense or an unallowable expense. And just another example of the having a great accountant on board definitely helps. So, what does it take for financial management? So you need to put a plan together, and that includes that's your budgeting and forecast piece. Your budgeting process, this really ensures that your team has the resources to achieve the goals that your company is setting out. That without budgets, you just run into problems. There's a lot of times that, and I've seen this on a lot of different cases, even on large construction projects I've worked on. We kind of have a budget, and we kind of have an idea where we're going, and then there's kind of this other pocket of contingency money for things that we don't really understand. And if you don't plan that dollar value out, everybody just keeps saying, "Oh, we'll take that out of the petty cash." It's just we're just budget. It's just part of contingency, no big deal. And then pretty soon, what you realize is you've taken everything out of that bucket, and a whole bunch of that stuff was things that you didn't plan for. And without that plan of understanding, you can't, there were things you knew were going to cost money, but you didn't plan for them. And if you mix that in with the unknowns, it makes it hard to see where your business is going. And so, then your next year, you probably adapt, hopefully, and you add a little more detail as you're setting your budget up. But the goal is to not have any, you want to have contingency, you want to have that flexibility in your budget, but you also want to define everything so you can tell when something new comes in. Like an example that happened to us is one of our clients is asking for a higher level of insurance. Well, that insurance cost is $6,000 a month for a $5 million insurance policy. So it's pretty expensive. Wasn't something we budgeted for, and we actually negotiated our way around having to do it. But had that number hit, that's not in my budget, and it's something that is a pretty substantial expense on an annual basis. And without planning my original if I just had insurance and I just let the auto come out of it and professional liability and our property insurance and all that stuff. If it wasn't well defined, I would have looked at it and just said, oh, it's just part of that bucket and I'm not over budget yet. But then by the time August or September came around, I'd be out of money. And then I flag would go up and I'd have to look and go, well, what happened? Here, being a little bit more proactive and a little more defined in those buckets of how we plan allowed us to see right away that, hey, this would be a expense that's really outside of what we were planning. So then the second part of financial management is really tracking what happened. This gets into your record keeping, invoice and accounts receivable, paying your bills, taxes, and then ultimately for some of us that are consultants or do DOT work and do DOT work, we report to MnDOT on our overhead rates. So some basic accounting terms. Some of these are pretty obvious, but accounts payable, that's your expenses, whether it's you got to pay for the one I just paid was for the printer, or for electricity, or all those things are things that people are going to send you a bill and you have to pay it. And accounts receivable are the opposite end of that. A lot of times referred to as AR. So that's your invoicing or your billing your clients. And so obviously that's important to stay on top of. Now your general ledger, this is one that's maybe a little more outside of what people are familiar with, but that's your system for your company's financial data. So it has all of your debt and credit accounts. It contains every transaction over the life of your company. So it's basically where if you write a check or you submit an invoice, or all of that goes into your general ledger. Now that for our company, that's stored in QuickBooks Online, and that's really the basis for all of your accounting. It's the basis for all of your reconciling your budgets and your actuals and comparing to understand if we're tracking well. And it's a process for developing your income statements, your balance sheet, your cash flow. All those pieces come out of the data that's stored in your general ledger. Chart of accounts. Now this is also directly related to your general ledger. Every transaction that comes into that general ledger is going to be tagged with an account, whether it's paying for a vehicle expense, or it's a wage or a healthcare expense, or could be revenue collected for work you did. All of those things are going to be allocated to one of the chart of accounts. And the chart of accounts can be super detailed. And I think I sent you out one, and the one I use today is going to be similar to what I sent when we talked about overhead rate development. MnDOT has just an example, and I use that same chart of accounts for what I'll show you guys today. But it's the buckets that all of your transactions get logged to, so you can analyze your budgets and create forecasts and really look back and see getting the visibility into your business. And if you don't have if you have really basic chart of accounts, like you could get away with, you probably couldn't get away with it, but you could just have 3 or 4 or 5 buckets to put your dollars in. But then when you're trying to budget and things aren't going well, without a little bit more detail, it takes you a lot more investigation to understand why things are going different than maybe you planned, or why something happened that you ended up with no money and you're not sure why. And so the more detail your chart of accounts, the kind of industry standard. MnDOT has an example, and that's with that example that we sent out for today. But your chart of accounts, then that flows into your income statement, which also called your P&L or your profit and loss statement. That just summarizes everywhere that we make money, and then all of our expenses. And so and then at the end of the day, you can figure out your operating income at the end of that. And that's a key component of understanding if you're in business making money or not. Yeah, operating income. So that's your gross profit less your operating expenses. It's a good way to measure your performance year to year. It's you can use it to develop other ratios in your business to compare them to other businesses in your industry. But operating income is kind of the starting point to where we our income statement gets us. Working capital, that's everything that you have that helps you generate money. And so it could be inventory if you produce something, it could be outstanding AR, it could be cash on hand, but it's everything that adds up to value that your company has produced. And so that runs all your working capital. Your cash flow statement, and we'll run through and develop a cash flow forecast, but your cash flow statement shows you where you have money in your business. And our business, we typically have, we're consultants, so we get revenue from consulting. And so we don't have a lot of different lines of cash flow. We're not financing other companies, and we're not generating revenue multiple ways. We get almost all of our revenue just comes from consulting income. Balance sheet, that one is kind of where your business is, how you see the value of your business today. That's important to an owner. It's important to if you have investors in your business, that kind of shows them what at any given time. A balance sheet is a snapshot of today. What is my business worth today? And it takes into account all of the accounts that you've put together. It takes into account all of your financing, all of your loans for maybe vehicle loans, percentage of if people have ownership in the company, that equity will show up on a balance sheet. And then at the bottom of it, you sum it all up and you remove all your debts, and then you see this is the current value of the company based on cash or based on dollars or existing information. Doesn't exactly it's not the valuation of your company, but it's the cash value of your company as of that day. So if you liquidated everything, that would be the money you would have. So then this one I just threw on your cash. This is how do you do your accounting? So we do our accounting on a cash basis. So that means if we have $1 in the bank account at the end of the year, it goes on that year's it goes on for that year's taxes, that year's financial reporting, everything for that year. The accrual basis is a lot of larger companies work on accrual basis, and that's more if you send out an invoice today, then those dollars go on your income statement today. Where our invoicing doesn't hit our accounting system until we actually get paid. And what it does is it helps it makes it easier for us to manage our business, because a lot of times we might be sending out large invoices and we don't get paid for months on them. And that's just causes a hiccup in cash flow. You might end up at the end of the year paying taxes on a whole bunch of money that you haven't collected yet. And that cash basis makes it cleaner, makes taxes and managing the business cleaner for a small business. At the bottom there, I just have a link that if you as definitions for basic accounting terms, I'll send out a sheet with all of them that I talked about and a few more that we'll kind of bump into as we go through today. But that's a good link that has hundreds of financial terms, and this PowerPoint will get sent out so you guys all have access to that. So we're going to get into some actually doing a couple of things here. I'm going to start out just a quick exercise in Excel. I think a lot of you will know how to use Excel, but for some of this is pretty new, starting their new business. What you can do in Excel and what you can't do in Excel is it's good to understand at least a few basics. And then the spreadsheet that I'll send out at one point, eventually I'll send out a blank spreadsheet. And that will, or it'll be not blank, but I'll send out an income statement that's pretty much empty, and you guys can fill in your own business in there. You create your own chart of accounts. Um, you can add lines or do whatever, and it takes a little bit of basic Excel use to be able to do that. So this is what we're going to build. It's super easy from a standpoint of a concept that people would understand. It's just a monthly mortgage payment calculator. And so I'm going to show you guys the formula bar. I'm going to show you a little bit on formatting and print area. And then I'll show you kind of how to do a couple of functions or how to find functions in Excel, and then just blast into a quick quality check. And what I like to do on all of my spreadsheets is find a way to double check your numbers, because there's a lot of reasons that when you mess up in a spreadsheet, it causes problems for people trying to make business decisions. It causes problems if we're submitting, well, obviously, but if we're submitting quotes to do work for somebody and we have an error in our spreadsheet, it can cost us money. So you see here, I got this Excel sheet pulled up. I'm going to run through a little bit of formatting, and then I'll run through adding some formulas to calculate a mortgage payment. And then I'll show you a quick check. So just formatting real quick. I like, if I'm going to use a spreadsheet to report for people, I like it to look somewhat nice on there. So, I always go through and just pick, where are my headers or my kind of my summaries of what I want people, and I'll do something to kind of make them stand out a little bit more. Maybe increase the font size. When I look at my view, I don't like all the grid lines. Sometimes they're nice while you're building things, but if you're going to print it out or something, they kind of get sloppy. So under view, I shut off my grid lines. Usually get your boxes kind of the right size. And then from here, I'll highlight my data entry spots sometimes. So here's where I'm going to enter data or do some sort of calculation. And so I'll just highlight them gray. And then kind of the two bigger buckets, I'll maybe highlight those blue. And that's where our answers are going to be stored. So now in Excel, this is a formula bar. So you can type in here. If you click on a cell, you can, if I just pulled these in real quick just so they're already in here. But if I wanted to type in here, I go up in the formula bar, I can add text. Like I just did, if I type something I didn't want in there, or I accidentally type in the wrong box, if you hit escape before you leave the box, it won't save that change that you made in there. So here we'll just walk through formulas. So price, this one's just a data entry. We're going to get a $300,000 mortgage. Annual interest rate is 5%. And so then I'll put, so monthly interest rate. So we'll do math. This is going to be up here in this formula bar. So we're just going to say this annual interest rate. So if I click on the cell, it puts C4. I'm going to divide it by 12. So that gives me a monthly interest rate. And then it should be loan duration. Loan duration, let's say 20 years, which is the number of months. I'm going to do the same thing up here in this formula bar. So I'm going to put the equal sign and then say, click on that cell C6, which is going to put the 20 in there and times it by 12 months. So I figured out there's 240 payments. And so that's kind of how the math piece works up here. You're using that formula bar. Now Excel has hundreds and hundreds and hundreds of functions that go a long way, and they can do a ton of things for you. So like to figure out a payment, if you put, it's called PMT, we'll do payment. I'll actually show you a different way. If you come up here, you click on that little F, and let's say I want to figure out my payment. It's not going to be that easy. Usually you can. Yeah, a little hiccup on it, but. So if you go into financial, And then you can find, like, there's dozens and dozens of functions. So I'm going to use the payment one, PMT. And so it'll ask me to put the rate in. So the rate, and this is per month, monthly interest rate, number of payments, we calculated that. The present value of the loan, 300,000, future value, we're going to assume it's all paid off. So the rest of these don't need any values, they're not required. And then you hit OK. And it calculates that payment for you. So that would be your monthly mortgage payment. So just the point here is we're not going to do a mortgage thing here, right? But I just want you to know there's a lot of functions in this software that can do a lot of good things. So then if I was to pay taxes on it, let's say it's $100 a month, and figure out my total monthly payment, my insurance maybe $150 a month. Total monthly payment. I wanted to show you the sum command. This is one you use a lot, and I use in all my spreadsheets. But so if you just type in sum and you highlight the cells, or you type that range in there, so this is C9 to C12, it adds it up. Oh, I went backward on this. This one, it's a negative, but there we are. So there's your total payment. And then the last piece I want to show you guys is just something that it's always good to double check, because you might put a sum in there and you might grab too many boxes and go, oh, well, that's my payment. It looks close. It looks fairly realistic. There's two different ways that I check things in Excel. If you highlight, that's just a simple addition. If you highlight a group of cells and you look down here on the bottom bar, it tells me the sum of those numbers is $2,229. And so that's the number I would have expected here. And it's wrong. So then I go, okay, well, what did I do wrong? Oops, Excel had me grab too many cells in that formula range. Adjust it. The other way that I do it is I'll just do a check. And usually I don't do this that often, but if I'm trying to find an invoice or find an error in something, I'll do this, where you'll take and add them all together and then subtract whatever the total is. And this is pretty simple here, right? But if you had 500 lines of data, or you're doing it across, Jeff and I have a fancy spreadsheet that he developed that tracks all of our invoices. And we don't get it screwed up very often, but when you do it, you got to poke around to find some errors. And so just some of the error checking, things like that is good. But the really quick one is if you highlight them down here, it tells you how many cells have data in them. Tells you the average, which doesn't matter much for this. It gives you the sum, which is what I was trying to check. Yep, now my sum works, so that data makes sense.
So this calculation that Ross just did is also the exact same calculation we do for a car loan. So we don't buy houses very often, but we may want to buy a car. So you do the exact same calculation. There's a value for the car and the interest rate and so forth, and the number of months. Usually it's, car loans now are 6 years. So 6 times 12. So, 72 months. And then you can calculate your car payment, and, same thing goes for, there's license tabs associated with your car, and there is insurance associated with a car. So you'd be able to do this exact same calculation for a car loan.
And then here I didn't show you, but we could calculate the interest paid, talk through the quality checks. So now we're going to get into an income statement. And so maybe I'll start by showing you an income statement. If I get it to pull up here. So we'll go to the end and kind of give you the answers before we start. But an income statement, and this is similar to what I sent out a couple of weeks ago when we did the overhead rate. It has your profit and loss. So it's your income, then these are costs, and then these are all costs. Your benefits are costs, general overhead costs. And then you have a total expenses, and you calculate your net operating income. And so that gives you the value of everything that is going on in your business. So this tells you, did I make money for this period or not? And so this period is for a year. So that's always good to know. Is this monthly or weekly or annual, or is it a snapshot of a single day? But now I'll kind of walk through all the pieces to get to this at the end. And so we start out with our chart of accounts. And again, we brought this up earlier, but these are the buckets that on that example that MnDOT had for overhead rate. These are the buckets that they had in there. I think I added cost of goods sold because I like to get the direct labor up here and any material cost, which is more relevant for somebody who's maybe dealing with a lot of equipment or actually producing something that they sell. The materials piece is a little more of that, but I like to get that up there to understand what it costs to produce what we put together or what we build or what we sold.
Ross, you
And
want
like I said,
to show
go
them how to
ahead.
do a spell check? Because
I can.
yeah, because there's a typo in your spreadsheet. I'll see if it finds it.
Yeah, it's slow motion.
Is that just checking the? You have to highlight the whole sheet and check the whole sheet.
Yeah, there it's coming. There are just a lot of acronyms in here, so
Those are okay.
I didn't find it on that one.
Yeah. Oops.
On that other one, there was
Yeah. At
This
the very
one.
bottom, there's it says operating income.
Yeah.
So Jeff and Ross, this is Tracy. Sorry to interrupt here. I'm multitasking, so I'm in between screens here, but it is a little tiny. I even have my glasses on. I'm wondering if you can blow your
Alright.
screen up a little bit. That would be helpful.
Yep, for sure.
Thank you. Thank you.
Yeah, my computer's slow, but yeah, so it fixed it. So up here, so I have it up here on this bar. Typically because I don't remember where spell check is on here. Trying to think of where.
I think it's
Under review, probably.
under review. Yeah, right here at the
Yeah,
far
so
left.
if you go under review, and then there's spell check. Now there's this bar up here. I add the things that I use a lot. So like if you right click on that little caret that points down, or just click on that caret, you can, like I always have a new spreadsheet, send to printer, email it to somebody. Spelling is up there on new redo. And so that's a quick way to put tools that you use a lot. Filters one I use a lot, but that one we won't use today. But
So are you gonna blow this up a little bit?
yeah, I can.
It's better.
So we'll start out at the chart of accounts. That kind of sets, here I have a couple of buckets that it sets up. And so organizing your chart of accounts by things that kind of work the same or work together, it is important. So just because as you do forecasting, like you may forecast all of your insurance a certain way, or you may forecast your consulting income and direct labor a certain way, which is different than your indirect labor, but just kind of putting them in categories that make sense are allows it's just easier to do forecasting. And you can always you can do a real general forecast, and then you can go more detailed on certain areas, and I'll show you kind of a spot that I did that. But so I have 4 big buckets here. I have income, cost of goods sold, fringe benefits, and then general overhead. And those are my big buckets, and then I have more detail. Now I could just start out and build a big spreadsheet and put together all of this on one spreadsheet, but I like to break down tabs. So Excel has tabs across the bottom. So you can take data and put them in smaller, instead of having all my chart of accounts drag through all these sheets, I can have my data in similar data on each tab, I guess is how I would say it. And that allows us to better manipulate data, or just cleaner to show people. A lot of times too much information, as you guys probably maybe are thinking right now, too much information can overload people and make it hard for them to get through all of your information that you're the forecast is intended to do, but so I'll jump back here real quick. So we're going to go through and we'll show you how to forecast those 4 buckets. So income, cost of goods sold, fringe benefits, and then your overhead costs. And this is setting your budget essentially. It's going to allow you to set your budget. It's going to allow you to see your cash flow. It's going to allow you to put together the picture to see your profitability. So one big part that is, especially in consulting, it's an issue, is there's a lag in collecting payment. And especially as a small business, there can be a pretty large lag because we're typically a subcontractor to a subcontractor, which a lot of us are that are working on bigger jobs, that we don't end up being the prime on them, especially as a small business. So it's important that you understand your cash flow conversion cycle is really what it is. But you start a project, you got to pay labor to everybody all month long because they're working, or maybe you're building something that you're not going to get paid for a while. And so you do this work and you do all this work. And then at the end of the billing period, the contract allows you to bill every 30 days, or maybe at the end of a milestone or something. So you bill it, or so we get all the timesheets together, we get all of our expenses together. Maybe it takes 2 weeks to get our invoice out. So now we started work on day 1. Now we're at day 30. It's going to be day 45 when we send that invoice out. Maybe we hit the billing cycle that the prime hit, maybe not, but hopefully within 2 or 3 weeks, the prime sends it to the owner, and then the owner takes 30 to 45 days to pay. And then hopefully the prime pays us. So somewhere in here, the prime gets paid and then we get paid. So you have this cash conversion cycle that it might take you 110 days to get paid for work that you did, obviously 110 days ago. And this is about normal for our business. It's a little bit less than that. It's probably closer to 100 days from the beginning of the first start of the month. From the day we send out an invoice, it's typically about 70 something days for us to get paid. So it takes a long time to get paid, which really, you need to forecast your income that way going forward to understand that if I do work today, I don't collect that money. And hopefully you get paid faster than that. If you're the prime on the contractor, we tend to get paid a lot quicker. Or if you have a private work, you might get paid a lot quicker than government work. But
so if your contract is straight with MnDOT, they usually pay you within 30 days of your invoice.
But as a sub to somebody, if you miss their invoice day, like one of our bigger clients, all of our invoices have to be in by the 5th of the month to them, or they hold them for a whole month to submit them. So we obviously do all those ones first. But if you miss that, if you have an error in one of them, or somebody sees something that they want you to change, you can miss that cycle and it stretches it out any longer.
Yep.
Now, this is important as you move forward with trying to figure out how much money am I going to have in my bank account on any given day. So forecasting income, there's 2 ways to look at. So I always do all my forecasting by month. We summarize it by year for our profit and loss, but I like to see it by month so I can understand that, well, we have a heavy business cycle, being most of our work is related to construction. So our business cycle has us not doing much work in the winter and doing a lot of work in the summer. And so if you do it by month, you can kind of see that fluctuation. So for a revenue forecast, there's 2 ways you can do it. You can do a top-down forecast that basically is like saying, we plan on having this much revenue per employee, or we plan on, we have 1 new crew and that's 20% increase in our crews, so we can do 20% more work next year. So we're going to forecast that we're going to collect 20% more dollars. And so that's kind of that high level pushing down and saying, okay, if we start up here at the high level and say, this is what we think we're going to do, what is the revenue for that? And it's just applying it to last year's numbers or some version of that. Or there's a bottom up approach, which can be more detailed, where we'll look at, and we do both actually. But we'll look at each project and what month the revenue is going to come from those jobs. And then you can see you get this revenue forecast out of it. Both of them are decent approaches. They both work. Like the top down, I like to apply for, like if we're giving raises, cost of living raises, or your rate table is going to grow by 6%, something like that, I might push from the top down and just apply it to last year's numbers and go, okay, well, what does that do to us? But then the bottom up approach is we'll look at projects and we'll even look at the people on each job, and we'll use that to push through to people, or to push through the numbers and go, all right, what does each month look like? So expense forecasting, and I'll jump back in the spreadsheet to show this, but some of them are related to production or related to how many hours people work, and others are not. You know, it doesn't cost, rent doesn't cost anymore if people are, if half the people are here, all the people here, our rent payment is still $5,000 a month, and that doesn't change. And so you have some costs that are easier to forecast that are related to the work that we're doing, and others are more stable throughout the year. So we'll talk through each of those. Go to my spreadsheet here. Lose that one at, there it is. So spreadsheet here, we start out with the chart of accounts. So I do have an example in here where I do, so we have each of these chart of accounts, right? These are these gray lines. And then we summarize our total income, total cost of goods sold, and get a gross profit. Now this is basically, you could hand enter in all of these numbers, which would be fine. Excel makes it quite a bit easier though, that we can build out a model or just some parameters and say, okay, for this one, this is kind of that top down. I just said, okay, this is the revenue by number of employees. And so I said, how many employees are going to be working for clients each month? And so I assumed our company has 10 employees. 3 of them are management or overhead. And then the other up to 7 of them can be billed to clients at any one time. So for consulting income, if I have 3 people and they create $19,000 a month, that creates $57,000 in revenue. And so that's pretty straightforward. So if you adjust the number of people, if you hire a person, this might become 8, or, you know, then it might carry through. Then it's, but it generates revenue based on the people working. And this is how we typically generate it here. Like I said, our business is has a pretty big curve in it. So we might do 3 times as much business in June, July, August than we do in January. These aren't our numbers. This is from just, it was easy to pull together because it's similar to what we do. But it allows you to see kind of that cash flow. Now I did build in the model, which is again, just a little more complicated, but I did put a collection period in here. So ours is typically 3 months, and this is a very basic model. So you got to use whole numbers or it doesn't work. But so when you do that, it shifts everything over 3 months. So now my direct labor cost comes in a month, but my consulting income has a 3-month delay. So it's just going through that concept of, you know, we have to spend money and we don't get paid for it for a few months. And so that's, it highly impacts your cash flow forecasting, because, you know, if we have 3 months here that we're going to make $58,000 and, you know, we have more than that going out, it gets to be a problem on your cash flow. Bottom up forecasting, this is, like I said, very similar. I use exact same spreadsheet, only I just listed out the projects and then I sum up the revenue by month, and I still use something that adjusts it. So this is cleaner to see what I did, that we do the work in January, we don't get paid for it till April. There's a 3-month lag. And if you put a 6-month lag in there, it pushes it all the way down to July, a 6-month lag, or some of your business might be 1 month, so so you put a 1 month lag in there, and I'll show you a little bit on the cash flows on why that's important. Otherwise, it's similar process. You guys will get this spreadsheet. You can play with it or look at it and see if it's interesting or not. Fringe benefits, again, if we have 10 employees throughout the entire month and it's the same 10 employees, typically our benefits are the same per month. You know, how much they're working, how much their medical costs are, you know, all these benefits are pretty stable throughout the year, with the exception of 2 of them that we've highlighted here. One is bonuses, that we pay bonuses at the end of the year. And then we have a profit sharing number that comes out usually in March. As Jeff said, our taxes are due on March 15th. And so you don't have to pay your profit sharing for last year until your taxes are due. So this shows you when the cash is going to come out, but it actually does go on the 2022 taxes. So it's a little bit of a, this works good for cash flow modeling. Your accountant might tell you to do it different if you're looking at figuring out your taxes at the end of the year.
Yeah, so
But
this
otherwise,
is the
go ahead.
one of the few transactions that you actually pay for it in the current year for the previous year's profit sharing. So that's the one of those expenses that's actually incurred in the year prior, or the expenses in the current year for something that occurred in the prior year.
So then the rest of these expenses, I just spread them the same every month. Like I said, they're pretty much, and this is just super quick, you know, put this together. Your business might be different. You might have different buckets over here. You might have a different chart of accounts. You might choose to roll some of these together. You might just have insurance, right? And all those are covered in one, or taxes. I think we do break out our insurance a little bit more, but our workman's comp is separate than these 3 are all bucketized together, and then our taxes are all together. So, you know, you can do it what best suits your business. And I think that's key to understanding your chart of accounts is go, okay, well, how does my business operate? What information do I need details to understand? Like breaking out workman's comp doesn't matter to me much because it doesn't change, or it changes, but it's nothing we can influence. It's just a cost that's required. And so it doesn't do a lot of good to break it out. You could throw it in the bucket with the rest of them, and there's probably never a time that I'm going to dig in and go, what happened to my workman's comp?
Yeah,
because the government just tells us what it is every year.
Right. And that's based on a certain rate. So the more labor you pay, more labor dollars incurs, then all these associated costs associated with them are all tied by percentage, basically.
Yep. General overhead, same thing. It's just another bucket of expenses. Now I break these out because they're not labor driven. Well, some indirect labor might be, but they're more costs that are sunk costs regardless of what happens. And so we tend to track each of these buckets. These are all pretty good buckets. I think we use all these. Maybe, yeah, I think we use all of them.
Yep.
We did add a different interest one for our line of credit, just because we like to track that, like to have visibility to the cost of that upfront in our reporting. I'm trying to think if there's any others that really pop out that are maintenance and or our automobile expenses, maybe say this a different way, are reimbursable a lot of times on our contracts. So we have separate buckets for automobile reimbursement for employee usage versus, or employee owned vehicles versus company owned vehicles. But otherwise you kind of set these up. Again, it gets back to that chart of accounts, but as you're looking at it, you're going, wow, I like to track this. So I better make a bucket that I can track it in, and it's better to get more detailed early so that year over year you can compare what's happening for each year. And if you stay pretty consistent, it's easier. You can add more as you go. You can go back in time and subdivide them, but that's kind of where we pull our accountant in to do that because she's pretty good at it. And like I said, what she can do in 15 minutes would take me a whole day. So it's worth having that. Even though she bills me $240, it was still cheaper to have her do it than it was for me to try to pluck through it and do it all day. She has a better version of the software that allows mass changes, and she has access, like Jeff said, right to our QuickBooks. And most accountants do have access to QuickBooks, so they already have a master login that you can give them access to your system and they can modify it. So it's just good to track. Now you notice a couple different things that I did different here. Most of them are just spread month to month, $800 every month, right? And you might know you have a big trade show, so maybe you end up with $10,000 one month or 5,000 or something. But the two that I did modify were my indirect labor is the first one, and that's because I employ 10 people all year long. And like I said, in January, I only have 3 people working on projects. The other 7 are indirect labor. And then as more people go to work, my indirect labor goes down. And just the point is I just kind of spread that out just for just to see that you can just hand type in ones that are important. And it's important to get most of these right. Probably of all of these, maybe 1 or 2 of them, do I actually, like rent and property taxes, do I actually just spread evenly? The rest of them, I do something to modify them just based on looking at history and going, okay, here's how we're going to have to pay the money. So if this is how we pay it, let's get it right in here so I can understand our cash flow, which is where we'll end up here in a minute. Auto insurance is one. Jeff and I were talking through this morning, and sometimes they'll let you go month to month, but we switched carriers and they made us pay the whole year up front. So if you get that in the right, if I would have spread that out and then I looked at my cash flow curve, I never would have picked up that, boy, I'm down $15,000 and I thought I'd only be down, whatever that is, $1,200 or something, $1,500 or something. But so then as you get these 4 categories, so we got our income done, we have our cost of goods sold done, we have our fringe benefits done, we have our general overhead items done. And then I can go to my P&L and I have a forecasted income statement or a profit and loss statement. So I could see from this business, this is our consulting income. We do have some sales. We tend to have a few little things that pop up here and there. And then we get rid of our direct labor, cost of goods sold, and then we have a gross profit. And that's a good number to track. Like it really shows you the production business side of your business, and are we making money, and really to compare to the previous year, are we growing it or not? And then you might not be spending the money down here, excuse me, as you might spend the money different. So your bottom line, your operating income may change based on all this overhead stuff, but this is kind of the client sales business side of are we operating or how are we operating the previous years or previous time periods. So I have a gross profit, and then I have, these are all my expenses. I have my fringe benefits, I have my overhead. You sum those up, you get your total expenses, you subtract the 2 or the 1 number from the other, and I have a net operating income. So that's my forecast income for this business for that year. If I don't like the number, like maybe I have investors and they say, no, you need to hit, this is roughly 13%. You need to hit 15% or 18%, or we're not going to invest with you. I would go back to the other sheet, but maybe we go back to working out of my house, so I don't have an office expense anymore. Well, I affected that bottom line pretty good. Profit went up quite a bit, but so there's, that's where kind of the planning and the scenario stuff really makes sense to go. If you get to the end and you put together a budget that you don't make any money, you might not want to be in business. It's you're taking a lot of risk if you don't have the profit or the net income to drive that profit or to drive that success. So from here,
Just a real quick comment. Ross, go back there. So if you scroll up to the top where it says income, typically if you're looking at a business for the entire year, that income, even though there might be a lag of accounts receivable and so forth from one year to the next, if you're looking at the entire calendar year, that number is pretty close to what you invoiced. However, if your business is growing and you have a large amount of accounts receivable, the income for that particular year might be a little lower than you'd thought for the amount of expenses you incurred. So if you're growing your business, a lot of times there's a lag in the income compared to the expenses, and so then the bottom line ends up being less than you thought. But then as your business then stabilizes with that growth, then your bottom line will actually increase over time. So just the difference between a cash-based business versus a accrual-based business. And cash is exactly what that means. It's the amount of money that you have in the bank at the end of the year.
Yep. Yeah, so that's dead on, is that if your business stays consistent, you don't have to lag this a whole lot. I do the lag, and I do that pretty much to drive my cash flow projection, which I think is it's one of the most critical pieces of managing your business. So I'll hit on a couple of points there. So one thing is, this is a lot of detail, right? And so you do want to manage the detail, or you want to manage the detail enough so your accountant says that you're good, but at the same time, it's useful to your business. And a lot of you that are running a 1-person or 2-person business or 3-person business, you might be doing a lot of the work, and to spend a ton of time, this is worth it. You hopefully can get through something like this in a day or so. Maybe especially if the next year is faster than the previous year, and you obviously get better at it, but it's definitely worth having the detail, but it has to be if you're paralyzed by it, then it's too much. So you got to think that through too, and go, all right, if it's just me and 2 other people trying to run this, and I'm doing half the work or maybe all the work, and I got to do all this, and I got to figure it out. There's a level of detail that doesn't always make a lot of sense. So actually, real quick, I'll go back to this. So once you have your income statement, so one thing I'll do is I'll save a copy of this, and we go through every month, and I put my actuals in here. So just these gray boxes, I delete them, or I have Elisa delete them, and she types in what we actually did, all the way for our income, our fringe benefits, our overhead, and then I end up with an adjusted forecast, and then I track that, and I usually have another column here that's like % of budget, and I'll track that, and that starts telling me where buckets start, or where we save money, or we saved money's the wrong word. We allocated money, and maybe it's kind of the wheels are falling off, and we're spending way more than we thought, or we're not collecting as much as we thought, or we had a big contract that had about a 6-month delay in payment due to some other outside issues, and that really starts to become a hiccup, because now you're not collecting that money, and you get 100,000, 200,000 behind on collection, and you go, okay, well, now I got to react to that somehow. But so a lot of people, like, one standard is they'll measure each of these as a total of the whole. And so, and maybe not so much for the income, but for the expenses. And so they'll manage these every month and make sure those percentages are staying kind of where they were targeted. So you might take that and divide it by the total and just figure out. Another quick Excel tip: if you put $signs around something up here in this formula bar, when I copy that formula, that it'll stay attached to that bottom number. And then you can format it up here as a percentage, and you don't need a lot of detail. and I copied and pasted it down here. But it's good to understand that good math works. That makes me feel good. But that my indirect labor is 57% of all of my expenses. Like that's a good thing to understand in your business. And and my fringe benefits are around 21% because I can go grab. It's not sitting here, but I got a book that has industry averages and it's probably a PDF now too, but you can get them online. You can search for how typical businesses operate, and you could see that 21% for fringe benefits is pretty normal in a company. It might even be a little low, but and this isn't our company. I just made all this stuff up while I was putting it together. But if you start looking at these percentages, and then if I had another year of data, I can paste those percentages in from the previous year and compare them and go, okay, am I trending similar to what meets industry standards? Am I trending to what I did last year? And then are the changes that are occurring, were they expected or not? That's a big piece to look at and go, is my business operating as I expected it to or not? And then do I need to react before it's a problem? Do I need to react or am I fine kind of just moving, continuing to go forward? So that's something, like I said, the percentage is pretty easy to calculate. I'll leave this formula in there when I send it out to you guys. So now we'll get into cash flow. And so the next piece, this is the biggest piece that kills businesses, is that as you're trying to, if you don't forecast cash flow and you run out of money, that's why you'd file for bankruptcy, right? Or you would, hopefully we don't go that far, but you got to go to your lender to get money or those kinds of things. And ideally we see that coming. There's nothing wrong with borrowing money to operate your business, but if it happens to you instead of you planning it to happen, it's definitely a problem. It's it doesn't, you don't sleep as well at night, I can guarantee that. And just in general, it makes it tougher to run your business. Jeff and Ann have done a kick butt job of getting this business here, and they have lots of stories about sleepless nights and things that didn't quite go like they hoped.
Yeah, so just the thing about cash flow is sometimes if something comes up that it's unexpected, then and you don't have a line of credit that's going to help you there, then one alternative is to file for bankruptcy. The other is to try to find other sources of money that you can use to balance it out. And Ann and I had a home equity loan that we would dip into on occasion when our cash flow wasn't quite what we thought. And so there's things like that can be done, I guess. The best way, obviously, is to have a lender that knows your business well enough and will provide you the opportunity to borrow money so that you can keep the doors open for those times when you need the cash.
Yep, exactly. So for cash flow forecasting, we've already put a lot of detail into what we're doing here. And so simplifying those accounts at this point kind of makes sense, because all we're going to do is take the data that we've already put together and summarize it. And if we summarize it at a level that if something isn't going right, we can go back to the detail and figure out why. But a cash flow forecast, if I have 4 buckets, and they're the 4 that I already talked about: your income, cost of goods sold, fringe benefits, and then your general benefits. But if you get more so detailed, that then it'll still show you the same thing, but people tend to use it less, look at it. So just a summary of projections. So going through the process, we're measuring cash by month, and I'll show you a graph here, or the Excel file here in a second. So we need to know our starting balance to figure out our ending balance at the end of the year. And so it's how much cash do I have in my savings account, and then each month as I go through and operate my business, am I going to use all that cash? Am I going to go into a line of credit or other debt, or am I going to make enough money? Ideally, you make enough money that you're always increasing your cash in your business forever, and that would be the ideal business. But yeah, so you're projecting the cash that remains each month. So hop back into the Excel sheet. So then the last tab that I have here is that cash flow projection. So with this business, I said, okay, last year, after we paid everybody out and everything, we finished the year with 25,000. Well, first, here's those 4 buckets I just told you about. They're the same 4 we've been talking about all day. Income, cost of goods sold, fringe benefits, general overhead. And this is just a summary that you can chase these formulas back, but income forecast top down E8. So if you went and looked there, E8 is the sum of those 2 numbers. It's the total income. Just like we thought, cost of goods sold, same thing. So you could track these formulas back by looking up in the formula bar and seeing what tab it came from, and then what cell within that tab. Runs through the whole thing the whole way. So we start out with 25,000. And if you ever do that, like if I click in my formula and I click the wrong spot, didn't do it that time, but that's letting me jump. But if you just hit escape, it usually goes away, or the undo buttons under the home menu are right up here in the corner. And Excel will let you undo for a long time. So if you screwed something up like I did yesterday, I think I hit undo about 30 times before I got my mess back, and then I was able to fix it and go back forward. Anyway, cash balance 25,000. January, we're going to make a little bit of income. So if we sum that whole thing up, about $3,200. This goes up 3,200. February, not as good of a month. We're going to lose money. So if I'm looking at this sum down here real quick, when I highlight those, we're going to lose 22,000. So 22,000 knocks off that, we're at 6,000. March, we're going to lose even more money. And this is our business model. So we're losing money. So it sounds bad, but it's part of our industry where we're seasonal, and you might be paying unemployment insurance. You might be paying people to maybe do other things around that are overhead, whether they're fixing equipment and building things around the office, or they're developing training and teaching and learning. But we end up, this is not uncommon for us this time of year to be just pulling out of having large amounts of expenses. So as you go through, I didn't do it. I had to freeze my fan. So as you go through, we could see our cash flow by month. It looks like we peak out at about $70,000 below what we need for cash. So that would tell me, if this was my business, I either need to start out with what, $95,000 in my bank account to stay positive, but I only have 25,000, so I better go get a line of credit for $69,200. Now, my gut tells me that number is wrong. It could be 10 grand higher or lower, just because, oh, maybe I have to buy another vehicle, or maybe, maybe I get more work than I thought and I go further in the hole. So I'd go get a line of credit for $100,000. And whether as a small business, it could be on your house, could be a unsecured loan through a bank, a lot of different things. But this cash flow model is powerful in understanding where your business is going. And so you don't run out of money here, because by the end of the year, we make $154,000. That's our cash in the bank at the end of the year. So it's a successful business, successful year. We made it. Then the next year we would start out that 154, and we wouldn't need this line of credit. But this cash flow model, super simple. It's just summing up everything we already went through and understanding our cash balance. But this is a key to not unexpectedly going out of business. I don't know, Jeff, if you have and we're doing better at this, but there's still big hiccups that you run into that change your business model. Whether, construction starts late in our industry, that tends to push. It doesn't have to start late, but if we got a good year, it starts early. These numbers will push down, or, I'm sure whether you're in that lawn care business, or, you get some of those similar project problems, or you're in a retail setting that has seasonal swings in different ways. But yeah, so that's cash flow. I said, it just,
so Ross, just keep going. So they see a positive number. So keep going down through the months there to see how eventually you're going to be in the positive. There you go.
Eventually, when December comes, you still have money left over to give that $25,000 Christmas bonus.
There you go.
keep your employees around, keep them happy. But yeah, so this is what, like I said, this is what what I do, what we do, Jeff and I have put together for operating our business. We don't manage a balance sheet really tightly or anything. We don't have shareholders that are pounding on the door wondering what we're making. And, it's good to understand those things because they do provide indicators, but most of our work just comes right off of monitoring that profit and loss.
So Ross, Rosa had a comment here about make sure you save this spreadsheet, and which is really important. And can you just show where the auto save feature is on the spreadsheet?
Yeah, and this could be a good thing or a bad thing, but up here, there's an auto save. I think it only works, Jeff, if you're using SharePoint or something.
I think
If
you're right.
Yeah, but so it's auto saving all the changes I make and everything, which I've opened it up and screwed things up and then looked up there and said, oh, it auto saved, and it can be painful. Good feature to understand, but yeah, it's definitely think about saving often. We always used to say that. The undo function works pretty good now. You can even go back on these files for version control. I know I screwed up Jeff's spreadsheet he developed to track our invoice system. I mucked the whole thing up one day trying to sort and filter and do stuff to it. And I was able to go back to the previous day. If you click on a file, I don't know if I have a good example of that or not, but if you click on a file, sometimes, just a quick tip maybe. I saw it under that, but yeah, previous versions. This one, I just moved everything over to this file today, so it doesn't have any previous versions, but you can always do that too, kind of a quick tip.
And just another thing that we do in our business is all our files are saved to the cloud. So if Ross is working on a file and saves it, I can have access to that. If you're doing all your calculating or your spreadsheets and it's on one person's personal computer, and let's say that computer gets stolen, you're going to be in a world of hurt. So I highly recommend that you use some kind of a cloud-based file system to save your files. And then everyone has access to those files, or everyone that you want to have access to those files can have it. So all our files are on the cloud, and Ross was working in it and I could work at it also and see the same things that he is.
Yep. Yeah, for sure. So like I said,
I was just going to ask here real quick. This is Tracy. I really haven't heard from any of the small businesses. Couple of comments, nothing in chat for questions, but I just want to pause here. We're like 5 minutes from the end of the class. Does anybody have any examples or best practices or something that you can share with us from your business that would be important? Well, you guys must be just presenting everything very well.
Well, I don't know.
Well, I don't know.
I think we might be overwhelming some folks here with all the information.
Like me. I took your first word of advice. Have a good accountant.
Yeah.
Yeah.
Because sometimes
and the key with all this is, I think that we could do this with 4 lines, right? Like we could show you how to manage it with 4 lines, and that would be it on each of these spreadsheets. So the detail is just based on kind of what's expected for a normal consulting company. Your accountant's going to push that, but if you just understand that, even if it's on a napkin or a pad of paper, I got these all over the place, just a small spreadsheet. If you put together a budget, and it's going to be wrong, and it should evolve through the year. Like that's the key piece, is that if you never look at it again and you never touch it, there's no point in putting it together. But even if it's small, and you could even focus on, like when I think of if I was doing a construction project and doing risk management on it, I look at the things that could go wrong or could change. So you do the same thing here and say, what if one of my plow trucks breaks? What if one of my key printers breaks, or my server gets attacked, if you're in one of these IT businesses, what would that cost me? And kind of monitor those buckets and go, well, you know, I mean, we're always getting hit with, I think our payroll company just got hit this week with some sort of cyber attack issue. And well, what if I couldn't make payroll or what? But just look at the things that you know are risks in your industry. And even if you just manage those, you're going to be way better off. There's, like I said, I'll give you the spreadsheet. We'll, you know, get all the information out there, but you're only going to remember 3 or 4 or 5 things. And it's kind of, you need to set up some sort of accounts, and that's required. Your tax, or you might already have them in QuickBooks, or you might have them in a spreadsheet. It's not required to use QuickBooks, but those accounts should be at the level of detail you're willing to manage. And then you should understand how your income is going to come in, and some sort of plan. You go, well, I'm going to win these 8 jobs. This is what I think it's going to be each month. It could be just one line, as simple, or one, you know, you could write it on a piece of paper and have January, February, March, what is my business going to look like all the way through the year? And then do the same thing with expenses and go, and then, you know, pretty simple, basic concepts. I mean, they're not, there's a lot of detail in here. There's a lot of, if you know how to use Excel well, I'll say there's a lot of fancy stuff, but if you really know what you're doing in Excel, which people do way crazy stuff in there, that's awesome. But so it's pretty basic Excel stuff. If you can sum, if you can put an equals to a different cell, you know, and do some math, a couple of multiplier or whatever, you can do 95% of what's in that spreadsheet. And, you know, like I said, you don't have to be overwhelmed with it. We've done planning before where we do rolling wave planning. We start out really simple, and then as kind of time moves forward, and you break the detail down. So you might just start out even with those 4 buckets. Go, what's my payroll? You know, what's my income, my payroll, my expenses, and just plan that out. And then compare it every month to the actuals, or every quarter maybe. But the goal is to keep it simple based on the level of risk that you have. And I'll hit on this last slide real quick. I don't want to go over, but this slide is basically about risk, you know, bridging over the slow times. So, you know, timing, understanding your business cycle. Does it make sense to buy a truck when you're already in debt, or when you know that cash flow cycle is going to be low and you're going to have to use a line of credit? Maybe not. Now, if you buy that vehicle and it makes you money tomorrow, maybe it does make sense. But just thinking through timing, what am I going to do? And in that spreadsheet, you could drop a truck in there and go, all right, here's 40 grand for a new truck. What does that do to my cash flow? Oh, I could see that screws it up for July and August. Am I able to handle that or not? Just kind of that scenario planning, managing savings. You know, so there's taxes, right? Like if you have $150,000 at the end of the year, there's taxes that you got to pay on that. You can look at paying your bonuses before the end of the year. If you pay them after the end of the year, you paid taxes on them, and now all your employees have to pay taxes on them. You pay them before the end of the year, that cash is out of your account. So if you have a good forecast, you can understand things like that. Profit sharing, kind of the same thing. And then just retaining cash, that's what we use ours for, is really to try to understand how much cash can we save, and do we need to save. And it's to reduce risk. You know, it reduces the reliance on your line of credit, unstable clients, government changes or delays. You know, in 2011, the state government quit paying everybody. That would sink our business today, probably. Maybe not sink us, but it would definitely be a hiccup if we didn't get paid for a while. You know, and then it gives you cash. If you plan correctly, you'll end up with money at the end of the year. You can go after market opportunities. You have the money to expand services or more vehicles, more crews, you know, whatever you kind of need there. Then my last thing, Jeff hit on this, but the line of credit, get it before you need it. People are way less likely to borrow you money if you're out of money. And that's where that cash flow model comes in. If you go show that to a banker, they're going to give you money, because you can show clients, you can show planning. They know you're sophisticated in what you're thinking. You know, so, you know, get it before you need it. And then one thing that's happening in all the businesses, but interest is up over 3% in the last 12 months, maybe higher than that now even. So there are unintended costs that you might not have planned on a line of credit. So it's worth understanding that too. But it's not bad to borrow. That's the other piece, is a lot of businesses, almost all big businesses, are all funded on debt. And so if you can get growth out of it or it makes you more successful, it's worth borrowing. Yeah, so that's everything we got. Not a lot of questions. I definitely am here to help you. If you want more discussion on something, if you want more training, if you have something that you want to teach me, I'm fine with all those buckets. We're all, there's always a lot we can learn. Jeff and I work together a lot and teach each other a lot all the time. Feel free to email me and I'll reply back, get you my number. I can review documents. I can help you build spreadsheets, any of that stuff. It's once you kind of get the template down, it's pretty quick. But I'll send you that template. That's all, doesn't have any values in it. We'll send you that example. I'll send you the definitions of financial definitions. We'll get all that stuff to you. Ann was saying that she wants that evaluation. So she sends you that. So I'll try to get some feedback.
And
She wants to see what you guys think of me, really, but
we're also willing to do one-on-one help if you need that.
So thanks, Ross. This is Ann. I jumped back on. You're exactly right. We're willing to do one-on-ones. We'll be happy to send all the materials for today, but just like with the RFP class, we'll wait and send those materials out until after you return your evaluation. So watch for me to send that out either today or tomorrow morning. And Ross, I'll let you sum it up. I just wanted you to know that I was back here.
yeah, no, that's everything I had. I think that's the next class. We'll get into manage it and that cash flow more. Jeff will talk more on that. I think we kind of hit the beginnings of how to manage that as you work through your business. Then there's that's on May 4th, human resources and employment law on May 11th. And then we have a couple other networking events in May. Tracy talked about that a little bit, and so those dates are also on the screen, and all that will be sent out to you.
Thanks, Ross. So the May 17th and 18th networking events are at our office. So PE Services is located in St. Louis Park in the southeast quadrant of Highway 7 and Highway 100. So the first one on May 17th, Building Your Team, is all about doing interviews and mock interviews. May 18th, Finding Other People to Work With. We'll be inviting professional organizations that serve a diverse demographic to join us after the class. And then on May 22nd, again, we'll be up in St. Cloud. I encourage you to sign up for that. And with that, I think I'll end the meeting. Thank you, Ross. Great job. Thanks, Jeff.
All right. Thank you.
All right.
Yeah,
Bye,
thank you.
everybody.